Commodity interview questions and answers. Are you preparing for a commodity interview and want to stand out from other candidates? In this video, I'll walk you through the top 25 commodity interview questions and answers that interviewers frequently ask. Whether you're a beginner or experienced professional, these powerful answers will help you confidently crack your interview. 1. What is a commodity? A commodity is a basic raw material or primary agricultural product that can be bought and sold, such as gold, oil, wheat, or coffee. Commodities are standardized and interchangeable with other goods of the same type. They are typically traded on exchanges and divided into hard commodities like metals and energy, and soft commodities like agricultural products. Commodity prices are mainly driven by supply and demand, geopolitical events, currency fluctuations, and global economic conditions worldwide. 2. What are the types of commodities? Commodities are broadly classified into two major types: hard commodities and soft commodities. Hard commodities include natural resources that are mined or extracted, such as gold, crude oil, and natural gas. Soft commodities refer to agricultural products or livestock, such as wheat, coffee, cotton, sugar, and cattle. These commodities are traded globally on exchanges. Their classification helps investors, traders, and businesses understand market behavior and associated risks better in financial markets. 3. What is commodity trading? Commodity trading involves buying and selling raw materials or primary goods in financial markets to earn profits or hedge risks. Traders speculate on price movements based on supply and demand factors. Commodities are traded in spot markets or futures markets. Exchanges like commodity exchanges provide a platform for standardized trading. Traders may be hedgers, investors, or speculators. The objective can be risk management, portfolio diversification, or profit generation through price fluctuations globally. 4. What is a futures contract? A futures contract is a standardized legal agreement to buy or sell a commodity at a predetermined price on a specific future date. These contracts are traded on exchanges and are commonly used for hedging and speculation. Futures help producers and buyers lock in prices to reduce risk. The contract specifies quantity, quality, and delivery terms. Most traders close positions before expiration instead of taking physical delivery of commodities in markets. 5. What is hedging in commodities? Hedging in commodities is a risk management strategy used to protect against adverse price movements. Producers, manufacturers, and investors use futures or options contracts to lock in prices and reduce uncertainty. For example, a farmer may sell futures contracts to secure crop prices before harvest. Hedging minimizes financial losses caused by market volatility. It does not aim to generate profits but ensures price stability and business continuity in unpredictable commodity markets. 6. What factors affect commodity prices? Commodity prices are influenced by several factors, including supply and demand, weather conditions, geopolitical tensions, currency exchange rates, inflation, and government policies. For example, drought can reduce crop supply, raising prices. Political instability may disrupt oil production. A strong dollar often makes commodities more expensive globally. Economic growth increases demand for raw materials. Understanding these factors helps traders anticipate price trends and make informed trading decisions. 7. What is spot market? A spot market is a marketplace where commodities are bought and sold for immediate delivery and payment. Transactions are settled on the spot, meaning ownership transfers quickly, usually within 2 business days. Spot prices reflect the current market value of a commodity. Unlike futures markets, spot markets deal with actual physical goods. Businesses and traders use spot markets for immediate needs or short-term trading opportunities worldwide. 8. What is leverage in commodity trading? Leverage in commodity trading allows traders to control large positions with a relatively small amount of capital. It is achieved through margin trading in futures contracts. While leverage can amplify profits, it also increases potential losses. For example, a small price movement can significantly impact returns. Proper risk management and understanding margin requirements are essential when using leverage to avoid substantial financial risks in volatile commodity markets. 9. What is margin in commodity trading? Margin is the initial deposit required to open a leveraged trading position in commodity futures markets. It acts as a security deposit rather than a down payment. Exchanges set minimum margin requirements to ensure traders can cover potential losses. If the market moves against a trader, additional margin called a margin call may be required. Margin trading increases risk and reward potential significantly in commodity investments. 10. What is arbitrage in commodity markets? Arbitrage in commodity markets refers to the practice of exploiting price differences of the same commodity in different markets to earn risk-free profit. Traders simultaneously buy at a lower price in one market and sell at a higher price in another. This activity helps maintain price balance across markets. Arbitrage opportunities are usually short-lived due to high competition and efficient market systems worldwide. 11. What is commodity exchange? A commodity exchange is an organized marketplace where commodities and derivative contracts are traded. It provides a regulated platform ensuring transparency, standardization, and fair pricing. Exchanges define contract specifications and margin requirements. They reduce counterparty risk through clearinghouses. Commodity exchanges play a vital role in price discovery and market stability. Traders, investors, producers, and institutions participate in these exchanges globally. 12. What is price discovery? Price discovery is the process through which market prices are determined based on supply and demand interactions. In commodity markets, exchanges facilitate this process through transparent trading systems. Buyers and sellers place bids and offers, and the equilibrium price reflects market sentiment. Accurate price discovery helps businesses plan production, manage risks, and make investment decisions confidently in dynamic commodity markets. 13. What is a derivative? A derivative is a financial contract whose value is derived from an underlying asset, such as a commodity. Examples include futures and options contracts. Derivatives are used for hedging risks or speculating on price movements. They allow traders to gain exposure without owning the physical commodity. While derivatives offer flexibility and leverage, they also carry significant risk if not managed properly. 14. What is contango? Contango is a market condition where futures prices are higher than the current spot price of a commodity. It often occurs when storage costs and interest rates are high. Traders expect future prices to increase. Contango can impact investment returns, especially in commodity ETFs. Understanding market structure helps traders choose appropriate strategies in futures trading environments. 15. What is backwardation? Backwardation is a market condition where futures prices are lower than the current spot price. It usually indicates strong current demand or limited supply. Traders expect prices to decline in the future. Backwardation can provide positive roll yield for investors holding futures contracts. It reflects tight market conditions and short-term supply shortages in commodities. 16. What is open interest? Open interest refers to the total number of outstanding futures or options contracts that have not been settled or closed. It indicates the level of market activity and liquidity. Increasing open interest suggests new money entering the market, while decreasing open interest shows positions are being closed. Traders analyze open interest along with price movements to identify trends. High open interest generally reflects strong participation and confidence among market participants in commodity markets. 17. What is liquidity in commodity markets? Liquidity in commodity markets refers to how easily a commodity contract can be bought or sold without significantly affecting its price. Highly liquid markets have many buyers and sellers, tight bid-ask spreads, and high trading volumes. Liquidity ensures smoother transactions and better price stability. Illiquid markets may cause price volatility and execution delays. Traders prefer liquid markets because they reduce trading costs and allow quick entry and exit positions. 18. What is a commodity index? A commodity index is a benchmark that tracks the performance of a group of commodities. It represents price movements of selected commodities, such as energy, metals, and agriculture products. Investors use commodity indexes to measure market trends and diversify portfolios. These indexes are often weighted based on production or liquidity. Commodity index funds allow indirect investment without physical ownership. They help investors gain exposure to broad commodity markets efficiently and systematically. 19. What is volatility in commodities? Volatility in commodities refers to the degree of price fluctuations over a certain period. High volatility means prices change rapidly and unpredictably, while low volatility indicates stable price movement. Commodity markets are often volatile due to weather changes, geopolitical events, and economic data. Traders monitor volatility to manage risks and adjust trading strategies. Understanding volatility helps investors determine position sizing and appropriate risk management techniques effectively in trading environments. 20. What is physical delivery in futures contracts? Physical delivery in futures contracts occurs when the actual commodity is delivered to the buyer at contract expiration. The seller provides the agreed quantity and quality at a designated location. Although most traders close positions before expiration, some contracts result in delivery. Physical settlement ensures market integrity and reflects real supply and demand. Businesses involved in production or consumption often use delivery to secure necessary raw materials efficiently. 21. What is cash settlement in futures contracts? Cash settlement is a method of settling futures contracts without physical delivery of the commodity. Instead, the difference between the contract price and market price at expiration is paid in cash. This method is common for financial commodities and indexes. Cash settlement simplifies trading and reduces logistical challenges. It allows traders to speculate on price movements without handling physical goods, making the process efficient and convenient. 22. What is risk management in commodity trading? Risk management in commodity trading involves identifying, analyzing, and controlling potential financial losses. Traders use tools such as stop-loss orders, diversification, hedging strategies, and proper position sizing. Effective risk management protects capital and ensures long-term sustainability. Commodity markets are highly volatile, so disciplined strategies are essential. Successful traders focus not only on profits but also on minimizing risks through structured and well-planned trading approaches. 23. What is fundamental analysis in commodities? Fundamental analysis in commodities focuses on evaluating supply and demand factors to predict price movements. Analysts study weather reports, crop production data, geopolitical events, economic indicators, and inventory levels. This approach helps traders understand the intrinsic value of commodities. Fundamental analysis is commonly used for long-term investment decisions. By examining real-world factors, traders can anticipate market trends and adjust strategies accordingly. 24. What is technical analysis in commodity trading? Technical analysis in commodity trading involves studying historical price charts and patterns to forecast future price movements. Traders use indicators such as moving averages, support and resistance levels, and volume trends. This method assumes that market prices reflect all available information. Technical analysis is mainly used for short-term trading decisions. It helps traders identify entry and exit points, improving timing and profitability in volatile markets. 25. Why do you want to work in commodity trading? I want to work in commodity trading because it combines global economics, market analysis, and strategic decision-making. Commodity markets directly impact industries and economies worldwide. The dynamic nature of price movements excites me and motivates continuous learning. I enjoy analyzing data, managing risks, and identifying opportunities. This field offers growth, challenge, and international exposure. My analytical skills and strong discipline make me well-suited for commodity trading. That wraps up our top 25 commodity interview questions and answers. If you found this helpful, make sure to like, share, and subscribe for more interview preparation videos. Comment below which question you found most challenging. Best of luck with your commodity interview. You've got this.